Hello and welcome. Moss Adams is pleased that you've joined us for today's session, ESG Trends in Manufacturing and Transportation. Before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have a couple great presenters with us today. We have Ashley Frizzell and Madison Poitras, both senior managers here at Moss Adams. Their bios and contact information are located in your webcast console. And now I would like to turn it over to Ashley to tell us a little bit more about herself. Ashley?
Yeah, absolutely. Thank you. Hoping everyone can hear me. Good morning, everybody. My name is Ashley Frizzell. I am a senior manager in our assurance practice based in our Seattle office at Moss Adams. I have spent pretty much my entire career in manufacturing and consumer products and have also spent almost my entire career in public accounting. I did do a brief stint in private, working as a director of finance at a solar energy company and one other company. So have kind of sat on both sides of the table, but have been passionate about ESG topics pretty much my whole career. And I serve as an internal subject matter expert for ESG for our manufacturing consumer products industry group at Moss Adams. And very excited to speak with everyone today about some of these topics.
Alrighty. Hi, everyone. My name is Madison Poitras. I'm an ESG senior manager, part of Moss Adams Consulting Group within our strategy and operations practice. My background has really been focused in ESG within a variety of industries related to ESG regulatory compliance, reporting with ESG frameworks, internal controls over ESG data, and overall ESG strategy. So today we have a very exciting agenda. Today we're going to cover what is ESG, examples of ESG business cases, ESG trends and challenges we're seeing in the manufacturing, transportation, and logistics industries, an ESG regulatory update and expected impacts with timelines, how can Moss Adams help, and then concluding with providing applicable resources. So in the same vein, our learning objectives are today, by the end of this webinar, we are hoping you learned what will be understanding the fundamentals of ESG, those top of mind ESG items, including proposed and finalized regulations, and the impact of manufacturing and transportation sectors that the trends will have on those industries. But before jumping into our content, I'm going to pass it over to Amy for our first polling question.
Thank you, Madison. So the first question is, how familiar are you with concepts of ESG? And your options are A, not at all, B, a little, C, somewhat, or D, I'm an expert. And the polling questions are located right on the slides that we're presenting. So if you can't see it, you can always hit the F5 key to refresh your console. And then to respond, please click the button next to the answer you choose and hit that submit button.
Yeah, we'll just give it a little bit of time here. Curious to see, how familiar everyone is with ESG. I know ESG can mean a lot of different things to a lot of different people and can cover, 200 to 300 plus topics. So curious to see how everyone feels. Okay, this is a very good group. So it seems like a lot of people, not at all or have a little, somewhat. No one has identified themselves as an expert. So this is a great segue into our first section of today's webinar, which is just an overview of what is ESG. So ESG is really a set of factors that businesses globally are using to help better capture and communicate decision useful information to a variety of audiences. It's really an opportunity for organizations to tell their story, whether that's taking credit for all of their ESG objectives, and many times it's acknowledgement of improvement areas and goals to be better in the future. So breaking down each letter in ESG, starting with the E, environmental information includes considerations of greenhouse gas emissions, the use of water, the release of waste, and the use of other natural resources such as forests. It addresses not only the use of energy and physical resources, but also the transformation of the economy and value chain. So to give you a flavor, some environmental metrics could be greenhouse gas emissions, emissions intensity, energy usage, water usage, but can also include climate oversight and board management. Moving on to the S for social. Social refers to resources contributed through relationships with humans. There are many ESG data points that relate to human resources. It can also be called human capital or human capital resources. This information includes employee turnover, diversity, and training. It can also include the protection of personal data that an organization collects. Some examples of social metrics include gender pay ratio, gender diversity, injury rate, global health and safety metrics, and human rights. And last but not least, we have governance, which refers to how an organization executes its transactions and manages its business. Some governance metrics include board diversity, board independence, supplier code of conduct. And now switching gears here a little bit. So where does ESG show up in your organization? So from this visual here, you can see that ESG can add value to various operations and impacts a variety of stakeholders. So for example, ESG is now a large part of the compliance function. For example, specific environmental or climate-related regulations, such as the California Senate bills, which I'll talk about a little further down in this webinar. ESG can also add value to the E in ESG within the tax group, such as investment tax credits, deduction for energy efficient buildings. Furthermore, ESG can add value reputationally for an organization by appealing to their stakeholders via communicating their ESG goals and initiatives. From an industry perspective, an ESG report allows an organization to provide comparable data to support their competitive edge by benchmarking against industry peers. ESG, is a holistic approach that influences the entire business model and operations, and that's what this visual here is really trying to represent. Piggyback off my previous slide, we're now going to talk about how the recognition of the relationship between social, environmental, responsibility, and financial success has initiated a torrent of demand for sustainability information. We've seen a large increase in demand for ESG data, and that demand has only increased in recent years due to a variety of reasons. One being investor interest. Investors increasingly recognize that ESG factors can significantly affect the financial performance and long-term development of companies. ESG data helps them assess risks and opportunities that are not captured by traditional financial analysis. This shift is evident in the growing market for sustainable investment products. Stakeholder engagement. There's a growing expectation from stakeholders, including customers, employees, and communities, for transparency and accountability in corporate practices. ESG data provides a way for companies to communicate their performance and efforts in these areas. Overall, the growing demand for ESG data reflects a broader shift in the global business and investment landscape towards sustainability and responsible corporate behavior. So this slide here shows some high-level business cases for ESG work, ranging from enhancing stakeholder relationships to an increase in access to capital. The benefits and business cases will change, obviously, based on the specific ESG work being completed and the pain points the organizations are trying to solve. But some examples would be operational efficiency. ESG initiatives often lead to more efficient use of resources, such as energy and water efficiency, which can result in significant cost savings. Waste reduction and sustainable supply chain practices can also contribute to operational efficiencies. So innovation and long-term strategy would be another business case. Integrating ESG factors can spur innovation, leading to new products and meeting evolving market demands, particularly in the realm of sustainability. It also aligns the company with long-term trends and market shifts. Risk management. ESG practices help identify and mitigate various risks, including environmental risks like climate change impacts, social risks such as labor issues, and governance risks like corruption. So companies that proactively manage these risks can avoid potential costs and liabilities. And now I'm going to pass it over to Amy and Ashley to talk through our second polling question.
All right, thank you. So the second question is, do you see ESG being a priority for your company in 2024? And your options are yes, no, or I don't know. And while you're responding, I do want to let you know that you have the option to submit questions for the presenters using the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards.
Thanks, Amy. Are we about at our response level?
Yes, let me pull up the results here for you.
Thanks. Yeah, this will be interesting to see. All right, that's fair. A lot of I don't knows. I was going to say, Madison, this will be interesting to see if, we do this question next year, every 6 months, sort of what the shift ends up being here as some of these regulations come to pass and start getting pushed down. So this is a great segue into some of the specific industry topics that we wanted to talk about today. As we're out talking to our clients and the companies we work with, just wanted to share some observations and trends we're seeing in some of these specific sectors. So to start off with, I'll spend a few minutes talking about supply chain focus. I think a lot of companies are seeing or hearing about the SEC regulations. California states come out with some regulations. Madison's going to talk about those. They impact really large companies, right? Publicly traded companies or companies with pretty significant revenues. A lot of really significant large manufacturers are also coming out pretty publicly now with net zero goals where they're targeting really significant greenhouse gas emissions by a certain year. And I talk to a lot of my clients who say, we're not subject to these regulations. We're not publicly making a statement for one of those goals. What's really the impact for me? And I would say if there's nothing else you take away from this presentation today, it's the fact that if your company provides services to or sells to a company that is subject to these regulations or has these goals, you are part of their supply chain, which means your activities are going to end up being reported as part of their supply chain, and your supply chain is going to end up being reported as part of their supply chain. So if you're selling or providing services to the Walmarts, to the Boeings, to the large automotive manufacturers of the world, and they have requirements that they have to report for regulatory purposes on their supply chain impacts, you're going to end up being asked by them to report. And, down the road, not only you're going to be asked to report, you may be asked to actually have third-party assurance on what you're reporting to them. So this really impacts a huge number of companies. And, because of that, we're really counseling companies now to really start thinking about ESG from a risk-based approach and really a risk management perspective, to focus on things like climate change and reducing supply chain disruptions. And kind of two specific risks to just sort of talk about, and these are identified in some of the regulations as well, are transition risks versus physical risks. So transition risks are risks specifically related to transitioning to ESG efforts. For example, if you're changing a vendor or something like that for ESG purposes. Physical risks relate to something like if you have a manufacturing facility in a floodplain, or a manufacturing facility in a country that is prone to earthquakes and has poor infrastructure. Planning ahead for some of those risks and identifying risk mitigation strategies. One specific example that I actually heard from a company during 2023 was about customs and blocks or delays by U.S. Customs of imports of products where there's concerns about ethical workforce practices. And I spoke with one company that had an interesting story that they had a component manufactured overseas that got stopped at U.S. Customs, and they said, no, we've toured our manufacturing facility. We're confident that there's no, labor force issues there. And the U.S. Customs said, actually, we're concerned about the raw material extraction process and whether there's issues with unethical labor practices in the raw material extraction process. So this company I was speaking with actually had to go a step further back in their supply chain and try and scramble and get data to prove that their early stage raw material extraction wasn't subject to bad labor practices, to be able to prove to U.S. Customs and get their goods released. So a really disruptive example of ESG risks here, and the need to kind of plan ahead. In the interest of time, I will skip Scope 3 emissions. Madison's going to talk through that in her regulation discussion, but just something that is sort of key in supply chain considerations right now. Traceability focus. I won't go through all the items here, but just to flag, these are some of the key areas where we're seeing, focus on wanting transparency in that supply chain and being able to understand, what's going on in your supply chain for your goods and services before they get to you. All right, and then shifting gears to manufacturing, a couple items here related to location of manufacturing and then a few related to process. So nearshoring and reshoring are both phrases that, you may have read some articles about them this year, seen them in some business discussions. They're essentially a response or a change from offshoring. So instead of having your manufacturing facilities overseas, often offshore all the way in Asia, nearshoring is bringing them back a little closer. For the US, that generally means in Mexico. And reshoring actually means bringing them all the way back from international to domestic and having those manufacturing facilities in the US. The advantages to that are more transparency and easier being able to see, kind of see what's going on at your manufacturing facilities. Also reduce shipping time and sustainability impacts from shipping. It can also help with, convenience and reduce supply chain delays, being able to have your facility closer. Decentralized manufacturing is essentially the same idea, where instead of having, one centralized manufacturing hub, you have smaller manufacturing facilities that are designed to be closer to where the end good is used. Again, reducing those shipping times, hopefully helping with supply chain delays. And also reducing the environmental impact of having things further away. Additive and subtractive versus subtractive manufacturing, we're seeing not as much, but it's worth just mentioning. Additive manufacturing is the process of doing something like 3D printing, where you're essentially adding layers to manufacture something, whereas subtractive manufacturing is a more traditional model where you would have a raw good and you would cut out the materials you're going to use in your manufacturing process, which means you end up with excess waste of your raw materials. The additive process is generally considered much more efficient from a raw materials perspective. Also in manufacturing, obviously continued focus on energy use and then the source of the energy, as well as raw material use and waste. And before I move on from manufacturing, I didn't include this on the slides, but a couple quick stories as just kind of examples of companies really trying to be creative and think through ESG opportunities in their manufacturing process. I had an interesting story from a company earlier this year, I guess in 2023, earlier last year, about how they had a product that had a rounded corner on the product, and they required specific packaging to be able to protect that corner in the shipping process. And they were trying to reduce their packaging and kind of improve on sustainability. And they were trying to figure out how to handle that. And somebody took a creative approach at the company and said, hey, do we really need this rounded corner? If we manufactured it with a straight corner, we could just eliminate the packaging completely. And that actually ended up being cheaper on the manufacturing front. It was a simpler process to manufacture without that rounded corner. And so it ended up being a great win-win, where they eliminated the packaging completely, had some sustainability wins there, and then actually had cost savings both from the manufacturing process and from not having that packaging material at all. One other quick story to share is heard from a company in 2023 that manufactured a component that went into car doors. And they were trying to figure out, they had a very toxic chemical in their paint on that component. And they were trying to figure out an alternative to not use this toxic chemical. And they were just having a lot of trouble finding something that would be an acceptable substitute given the requirements of that component. And again, taking a big picture perspective, thinking creatively, trying to look outside the box for opportunities, somebody said, hey, this component goes inside a car door. Does it need to be painted? And lo and behold, they went back to the manufacturer, and the manufacturer said, nope, we don't care. Nobody sees it. It does not need to be painted. And they actually just eliminated the paint entirely. Again, a win from an ESG reporting perspective, and then also a win from a cost and manufacturing perspective. They eliminated an entire step in their manufacturing process. So again, from a manufacturing perspective, thinking creatively and really reevaluating some of the process can be quite helpful. Moving on to transportation, Madison and I gave a presentation last week that included some discussion on e-commerce, and we talked about electric vehicles and sort of that last mile delivery, where we're really seeing a lot of shift to electric vehicle fleets because it's local delivery, small vehicles. It's a relatively the technology is there right now to be able to kind of make that shift. Unfortunately, for long haul transportation, overwhelmingly, there's still a lot of obstacles to overcome. Significant barriers relate to battery size and weight. For large trucks, scarcity of charging stations, the time required to recharge a battery, even if you do have charging stations, as well as the high initial investment for electric trucks. We are seeing more and more government incentives trying to help with those initial purchasing, as well as investments in building out the charging station infrastructure, especially in some states. But the good news is there's also a lot of other innovations that are being worked on. These concepts of sort of efficient transportation networks or smart transportation networks, where different companies and regulatory bodies or governmental bodies are trying to work together and share technologies to essentially adopt smart technologies to do things like improve route planning, reduce fuel consumption, and other efforts to sort of create overall transportation efficiency. All right, and then also wanted to close out and just identify just a few ESG challenges that are specific before I pass this back to Madison again. Regulatory complexity is an obvious one. There's a lack of consistent formal guidelines. There's a huge amount of complexity in ESG concepts, and it can require really significant expertise. It's really an area where we often recommend getting an external consultant or a partner to assist. Cost is also obviously always a challenge. I gave some examples earlier of some cost savings, but investing into new technologies can be really expensive, and working on ESG efforts may require hiring additional staff or making changes to the supply chain, which again can be costly. Also, just considerations around external stakeholders. You can have a lot of different external stakeholders with different priorities, and balancing that can be part of the challenge. Technology as well, both to capture and then also to report on ESG efforts. This is the regulations coming out. This is kind of a new field, and so companies I talk to, there's a lot of different tools out there now for ESG reporting. It doesn't sound like any of them are perfect yet, and sort of evaluating all the different options and figuring out what plays well with the technology you already have can be challenging. So one final item to flag, greenwashing is probably something folks have heard about in the news. We are seeing continued increases in litigation cases and fines related to greenwashing for those who have consumer products. There's actually class action lawsuits now about sustainability claims that are considered greenwashing for certain products. So again, an area where just from a risk management perspective, considering getting third-party assurance and having a independent party verify claims you're making publicly related to any ESG efforts can really mitigate some of your risk. All right, and with that, Madison, I'll pass it to you to talk about some of the regulations.
Awesome, thanks, Ashley. All right, so we're going to jump into our ESG regulation update, starting with the SEC climate disclosure. Before jumping in, I do want to note we're just focusing on the United States today. A lot is happening internationally, but with the time we have, we're just focusing on a handful of regulations. So the SEC issued this regulatory proposal in March of 2022. This mandates public companies to disclose climate-related information within your financial reports, such as your 10K. There have been a lot of delays connected with this proposal. It is now expected to be voted on before April of this year, although the SEC has yet to set a firm date. The delays have been connected to the SEC considering changes to the Scope 3 greenhouse gas disclosure and the materiality threshold that is currently within the proposal. So that being said, this hasn't stopped many of our clients from being proactive in this space to understanding their Scope 1 through 3 emissions. In addition to clients that have already calculated these emissions are now looking for that independent third-party assurance. One thing I do want to point out here, everyone talks about the greenhouse gas emission disclosures, but there are other disclosures a part of this proposal, such as qualitative disclosures, how climate-related risks are likely to have a material impact on your business model and outlook, governance disclosures, such as board and management oversight. So there is much more than just the greenhouse gas emission disclosures. I know in the news we always hear about Scope 1 through 3, but really pay attention to those other disclosures within this proposal. All right, now we're going to jump to the California Senate bills. California has been very busy. So starting with California Senate Bill 253, also known as the Climate Corporate Data Accountability Act. SB 253 will require any public or private company earning over $1 billion in annual revenue that have California operations to publicly disclose their greenhouse gas emissions that are released from their operations and supply chain. Subject companies will measure and report these greenhouse gas emissions in conformance with the Greenhouse Gas Protocol. For those that aren't familiar with what that is, it's the gold standard for carbon accounting. Entities will have to submit their emissions information to an emissions reporting organization that will be designated by CARB. CARB stands for California Air Resource Board, and the organization will develop a publicly accessible digital platform for the emissions data. So fees corresponding with the California Senate bill, if companies fail to adhere to the demands of this law, they will face fines of up to $500,000 a year, according to how the bill is currently written. All right, so tentative timelines for this. As the bill is currently written, Scope 1 emissions and Scope 2 emissions will be performed at a limited assurance level beginning in 2026 and a reasonable assurance level beginning in 2030. The Scope 1 and Scope 2 emission disclosures will need to be reported starting in 2026 and the Scope 3 emissions beginning in 2027. So what's next? The California Air Resource Board need to pass regulations by January 1st of 2025 before companies start filing disclosures in 2026. But more to come on this California Senate bill. The governor has made public comments about this California Senate bill in addition to this next one that I'm going to cover. So California Senate Bill 261, which is also known as the Climate-Related Financial Risk Act. This will require companies with greater than $500 million in annual revenue and are doing business in California to prepare a biennial report disclosing climate-related financial risk and describing measures adopted to mitigate and adapt to that risk. This report needs to be reported in accordance with the TCFD framework, which is the Task Force on Climate-Related Financial Disclosures. This bill will require on or before January 1st of 2026, and then every 2 years thereafter. So fees, similar to 253, 261, penalties of up to $50,000 in a reporting year. So what's next? Similar to 253, 261, the governor has noted concern about the overall financial impact of this bill on businesses. So he has instructed CARB to closely monitor those cost impacts in addition to the 2026 implementation date to ensure CARB has sufficient time to carry out these requirements. This visual here just gives a little bit more representation of what TCFD is. As a reminder, TCFD is the framework that 261 bill needs to be reported with. So the task force structured its recommendations around 4 thematic areas that represent core elements of how organizations operate, from governance, strategy, risk management, and lastly, metrics and targets. The 4 overarching recommendations are supported by disclosures that build out this framework with information that will help investors and others understand how reporting organizations assess climate-related risks and opportunities. All right, with the little time we have left, we're gonna end with how can Moss Adams help? I know we talked a lot about different areas today, so this slide really here is supposed to be representative of a service that Moss Adams provides to support wherever you are in your ESG journey. So starting with ESG examinations or reviews, if you've already collected and aggregated your ESG data or your greenhouse gas emissions and are looking for an independent third party to provide an opinion over that data, Moss Adams has an ESG assurance team that is able to provide these types of examinations and reviews. ESG software, if you're looking for a system of record for your ESG data and you need to implement a technology solutions, we have a system enterprise team that can help get you set up so you have a better handle of your ESG data. And then our ESG consulting services includes a variety of things, but if you need assistance with board governance assessments, we work with boards, commissions, and committees to assess board and committee effectiveness, evaluate relationships between boards and executives. ESG strategic planning, you need help with a materiality assessment or a roadmap for future reporting. Specifically focusing on climate, we can do greenhouse gas emission calculations, calculating your carbon footprint, a greenhouse gas readiness assessment. Maybe you've already calculated, but you're not quite ready for that assurance opinion. You want to make sure that your calculations are in line with the greenhouse gas protocol. And we also have an expert ESG tax advisory team where you can take advantage of the tax credits and incentives through deductions for energy efficient buildings, low income housing tax credits, investment tax credits. So that was a lot. I'm now going to pass it over to Amy to conclude our session, but obviously Ashley and I were fast and furious today, so please don't hesitate to reach out if you have any questions at all. Amy, over to you.
All right, well, thank you, Madison and Ashley, for a great presentation today. And to our audience, if you have further questions or comments, please reach out to us and we would be happy to continue the conversation. You can drop a note in the Q&A window now or reach out to our presenters directly. Their contact information is in your console as well as in the slide deck, which you can download now from the handouts window. We also invite you to visit our website for more resources and information on ESG, some of which are linked in your console. And then finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. And again, thank you for joining us and take care, everyone.
Thank you.